welcome back to the Make Account podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
And I'm Tyler Warner, small business owner with a lot of accounting questions. Today, we're talking about employee retention credits.
Yeah, this is an update.
An update. And if you're a business owner, you've probably gotten a text message, an email, a letter in the mail.
Yeah.
Phone call.
I have voice.
Woof. A whole. You remember from The Office? Is it a woof or
I'm
a
like
bark?
The only person that's never watched The Office.
Oh my god.
Yeah, that's a whole other podcast episode.
Yeah. All right. Well, for those of you, you know.
Yeah.
All right. Let's move on.
Yeah. I was gonna say I think if I'm looking around for my phone, I don't see it. But if I pull my phone out, I have 3 voicemails right now with, just hey, this is Jeff from Tax Credit Solutions, just following up on that $26,000 per employee you're owed.
Yeah.
So what I want to do today is kind of unpack it again. And we did the basics on it. I'm looking at this. This was in November of 2021. We'll kind of go back over it, tell you what we're seeing now because they're starting to get audited, these claims. Walk through the basics again, give you some understanding, and also give you some things to think about when people are approaching you. Mm-hmm. Making claims saying you qualify, because in the CPA world, the big issue right now is a lot of CPAs are just getting fed up with what they're calling these ERC mills. They're literally like these companies that are just sprung up because they see a huge opportunity to because their fee is based on the credit. So CPAs can't do it. We can't charge a contingent fee. We can charge a value fee, but we can't say, I'm going to charge you 15% of the tax credit. Like, we can't charge a fee as a percentage
It's
of
almost like, am I understanding? Like, it'd be like if like how lawyers sometimes get paid based on like the case winning, not what do you call it?
Yeah, like getting a judgment.
Yeah, exactly.
Yeah,
so if the client gets $1 million in a legal case, the attorney gets paid a percentage of that versus just charging a standard professional services rate. Right.
Like we can't.
So CPAs can't do that.
We can't charge we can't charge a fee contingent on a tax outcome. Because the thinking is the tax outcome is fixed. Like you're entitled to these credits whether I file it or not.
Right.
And so now, like, we charge kind of a value fee based on the amount of work to do and all that, but we don't tie it to the credit. And I'm only saying that to say these credit companies are coming out because they're like, shoot, we can see people that get $1 million credit, we charge them 20%. The business owner's like, win-win. I was never going to get this $1 million. I'll give you $200,000.
Sure.
And they really tout that you qualify. That's the first kind of thing I would say is if you're getting these letters, I've seen letters that they spoof an IRS letter and it's like, you're entitled to $26,000. We'll talk about what the $26,000 mean, or the voicemail I just referenced. They pop up, they file these claims for you, and they make all kind of disclaimers about what they will and won't do. And most of them is, we won't defend you in an audit. Mm-hmm. We won't really support you. And you don't even know if this company is going to be around. So it's becoming like this big deal. And then I think what's happening too is you go the other way. It's getting people that probably really legitimately qualify that are probably scared and may not qualify. So what I want to walk through is break through the noise a little bit about all these ERC mills coming at you saying you qualify. And the spoiler is a lot of people don't qualify. But then also tell you how to do it legally, ethically, and professionally and get the claim you're entitled to.
Okay. Legally, ethically, and professionally.
I know. I know.
Beautiful.
Didn't that roll off the tongue?
Yeah. Let's do it.
All right. So let's talk how you qualify for the credit. Okay. 2 ways. One is you had a suspension of your operations. And the way I was reading here is the article in the Tax Advisor. It's a 2-part test. It's you must establish that you were shut down pursuant to a government order in effect, like literally federal government, state government. Like the perfect example is the restaurant. You can't have in-house business. You can only do takeout.
Right.
And that order has a more than nominal impact on business operations, either due to suspending them or requiring modifications. Okay. Bunch of words there, all to say this is the area that the ERC mills are going after, the highly subjective shutdown areas, which is subject to interpretation. Beware. I would say buyer beware here, because it's a 2-pronged government order in effect and more than nominal shutdown. I'm not going to get into that so much to say if somebody comes at you and your CPA has said, I don't think you qualify, and they're claiming you do on this criteria, I would pause. I would say that's one of the takeaways. If they're saying, oh, you had a cargo container outside of LA, remember that when that was a and people are claiming that was a suspension of your business. Well, does that also meet the government order in effect? Like, you got to think through these things, and people are taking really hard to defend positions to qualify you for the credit, because that's the more subjective one, the one I think is more fraught with error, quite honestly, and where you can get in a lot of trouble. Okay. The second criteria is what they call a significant drop in revenue. I don't think that's the exact term, but basically what you do is you compare your quarterly revenue, and revenue is defined what most people would think is revenue, but there's things like interest income and gains on sale of assets and all that gets thrown in there. You compare your income on a quarterly basis in 2020 to 2019. So first quarter of 2020 to first quarter of 2019, or first quarter of 2021 to the first quarter of 2019, so on and so forth. So always referencing to the quarter in 2019. Your revenue had to drop. In 2020, it had to drop 50% or more. So hard to meet that.
Yeah.
In 2021, it had to drop 20% or more. Again, relative to the same quarter in 2019. Okay, so you can start to see where there's some businesses that could have had a 20 to 30, 40% revenue drop in 2021, but maybe not meet the 50%. Okay, so that's the criteria to qualify under that revenue drop. All right, take it a step further. Where are they getting the $26,000? Okay, the $26,000 is a combination of two things. One, it's the $5,000 maximum credit you could get per employee in 2020, and $7,000 per quarter in 2021 for 3 quarters. So that'd be $21,000 in 2021 maximum. $5,000 maximum for the year in 2020 totals $26,000.
Okay.
Follow. Got it. Okay. So let's unpack it a little bit. Put some numbers to it. It's always the best example. Let's just say, and then, you might ask the question, why not fourth quarter of 2021? Well, the answer is, by law, they just ended the program. They said there is a caveat for what's called what is it called? Recovery startup business. Third and fourth quarter of 2021, if you weren't in business and you started a new business, you can take up to $50,000 in this credit for third and fourth quarter. So that's an interesting side note. Not a lot of clients or taxpayers realize that. But if you had a new business, you couldn't meet the revenue drop. You didn't have a 19 revenue.
Right.
You can do what's called a recovery startup business. I think it's if you started your business after February 15th of 2020. I need to check on that, but that's essentially, I think that's the date. All right. Let's say 2020 second quarter, you did $60,000. Let's say $40,000 of revenue, and in 2019 second quarter you did $100,000. You would have had a $60,000 drop. That as a percentage of 2019 is 60%. So you would qualify. Here's a quick thing to remember when you're thinking through the revenue drop. If you qualify in one quarter, you automatically qualify for the next. But it's two different ways you qualify, but then I'll go through that. So in 2020, the law reads, you get the credit for the first quarter, the revenue drops 50% compared to the prior year. And then you end it on the quarter following the month your revenue returns back to 80% of what it was. Okay. So already you can see if you get one quarter, you automatically get the next, even if your revenue went up, because it's the quarter following the quarter your revenue went up to 80% of what it was. Okay. So all that to say, in 2020, you're going to get 2 quarters. If you meet one, you get the next one. End of story. 2021 has a different rule, but allows you to do, in effect, the same thing. So 2021, again, you have to have a 20% revenue drop. Okay, so let's put some numbers to it again. 2019 second quarter, again, $100,000 of revenue. Let's say 2021 revenue, second quarter, $70,000. That's a $30,000 drop, 30% revenue drop. You qualify. Okay. Now you automatically qualify for quarter 3 based on this rule. There's a rule that says you can use an alternative quarter to determine if you qualify. So in the third quarter, you could just say, well, did I qualify in the second quarter? Mm-hmm. Yes. So in effect, you always get subsequent quarters. Different rules in 2020 and 21, but the same effect. So it's really kind of taxpayer friendly. If you qualify at any quarter of 2020, you automatically get the next. Same thing in 2021.
Okay.
All right. That's qualification. Now we get into how is a credit claimed. The credit is, in 2020, it's a maximum of $10,000 of wages at a 50% credit level. So $5,000, that's how you're getting it.
Before, and I should have jumped in a minute earlier. So you mentioned there was 2 ways to kind of like qualify, right, and there was some discrepancies on those. And so as far as the second, the math part, right, that should be pretty black and white, right?
Math part is black and white no matter what method you use to qualify.
Okay.
Yeah, so you had the shutdown, like government said you had to shut down, and it was more than nominal. Yeah. So wages paid during that period qualify.
Right. That's black and white. How you file.
Well, that's subjective. The credit is black and white, I think is what you're pointing to.
Okay.
Then the revenue drop is just a way to qualify you. But then if once you qualify, you're in the same boat no matter what method you got to qualify.
Okay.
Only difference being under the suspension method, you only can claim wages during the period you were actually suspended, like shut down.
Okay.
Under the revenue drop, you get all of the wages for the quarter you qualify. And like I told you, in 2020 and 2021, if you get one quarter, you always get the next.
Okay.
So you're talking about the wages you pay during the qualifying quarters.
Okay.
Okay.
All right.
2020, doesn't matter what quarter. It matters what quarter you qualify. But my point is, you get $10,000 per employee for the whole year. So if you qualify for second and third quarter, if you pay that person $10,000 in the second quarter, that's the most you're going to get. 2021, it's $10,000 per quarter per employee, and it's a 70% credit rate. $10,000 per quarter, 70%, that's $7,000. So once somebody gets to $10,000 of wages in a quarter, you're maxed out, and you get that every quarter. So in just kind of a takeaway, the credit's much easier to get in 2021, and it's much more lucrative. Okay. So let's drop back a little bit and just talk quickly about tax credits. You've said this before, and I think it's a good analogy. A tax credit's like a gift card, right? It's like if your total tax was $10,000 and I gave you a $10,000 credit, your tax now is zero, right? Versus if I gave you a $10,000 deduction, your tax only goes down by the tax rate you pay on the $10,000 or save. So if you're in a 25% tax rate and you get a $10,000 deduction, your taxes just went down $2,500.
Gotcha.
So credit's way more lucrative, advantageous, whatever word you want to say. Tax credit's way better, right? It's like money back in your pocket. And in effect, the employee retention credits, you literally get a check. Like if you had a claim for 120, like I have a client, they have a $2.3 million claim. Like they're going to get, it's for multiple quarters, but let's just say they send it in one check. They're going to get a $2.3 million check plus interest. Like literally, I've seen the check. It's crazy.
Wow.
So that credit is ultimately, normally a credit's not taxable income, but in the employee retention credit, it's taxable. So if you make the claim for 2021, you have to go back and amend if you claimed it for your business tax return, and then if it flowed through personally, ultimately to your personal tax return. And the way you do that is you go back and you reduce your wages by the amount of the credit. It's either income or reduction. It's the same thing, right? You could either say you have more income or you have less expenses. That is the same result because that's the way they tax you on it. So another thing we see is people like saying they didn't know they had to amend. The ERC company comes and says, hey, you're getting $150,000. You're like, great. You have to amend your tax return and claim it as taxable income. So it takes a little bit of bloom off the rose to a certain extent, right? I mean, obviously still if your tax rate's, 30, if you pay a third, still, 50 grand on 150, still getting 100 grand net. Yeah. But just beware, you have to amend your tax return for the year the credit relates to, not when you get the money. That's another thing. People are like, well, what if I don't have the money yet? I was in a continuing education the other day. Technically, you're supposed to amend at the time you make the claim. Now, practically, I think that's debatable. So I'm not giving you tax advice here. Yeah. But I'd be hard-pressed to amend a tax return without the money in my hand. Because
I see.
You get what I'm saying?
Yeah.
Like let's just say like 2021, everybody for the most part's done their 2021 tax returns. Let's say you go back and file employee retention credit and you get a $50,000 claim. Do you want to go back and amend 2021? Again, I'm not telling you not to. You're supposed to. But practically speaking, do you want to go back and amend 2021 until you know you're getting the 50? Like you have it in your hands?
Yeah. To that end, like, do you know, like, is there a delay between like knowing you're getting it and then it showing up in the mail? I mean, I'm just thinking you just described a $2 million check.
Yep.
I mean, that's
And for that client, we did it. We already included it in their income because we literally were filing the tax return. I thought it was the right thing to do. To answer your question, no, you don't know. The IRS is well, first of all, you paper file these claims. I hadn't said that yet. You file an amended payroll tax return, a 941X.
Nice.
Yeah, I know, right? And you make it's a payroll tax credit. So you don't know. You literally get a letter in the mail that says we've adjusted your payroll tax returns and you're due a credit. And that's when you're like, oh, I'm getting the money. And then literally a week later, you're like a week, 10 days, you get the money. But until you get that letter, I've had clients it takes 6 months. I've had clients it takes 9 months. I've had clients it takes infinity, I guess is the point out, because we don't know yet. We filed these. I have one client we filed for $900,000. They got paid $350. Waiting on them. They're asking me, hey, where's the money? I said, look, man, I told you when we did this, you can't get them on the phone. It's hard to tell when you're getting it. So,
jeez.
Yeah. So let's kind of recap. You got the two ways to qualify, either a suspension of operations or a revenue drop. Key here on the revenue drop, just so people leave kind of understanding, you have to use the same method of accounting for the revenue drop as you use for your tax return. Now, most people, they're cash businesses. What I mean by that is people record their revenue when they collect it. Mm-hmm. That's how most people file their tax return. Yeah. It's called cash basis. The other method is accrual method, which is you record income as you earn it, meaning as you bill people, whether they've paid it or not, it's income. Yeah. So just be thinking that's the method you have to use. If you ever read
Accounting for Dummies, you'll get the hang of it real quick. It's like chapter 1. That's as far as I got.
You did read Accounting for Dummies. Well, you said
this is the time of year when I usually get real ambitious about accounting.
Is this when we tell the story about you walking to the office barefoot from 3 miles away? Is this what we talked about? Did that come? There's a backstory to that.
Yeah, probably.
Yeah.
It's the time of year we're all making new goals, getting ready for the new year.
For you, it was to be a more informed accountant, or to be an accountant.
Yeah, and look, here I am.
And here you are,
co-hosting a podcast.
Right. Yeah. So, you got to amend the returns. You got to pick it up as income. You got to know what method to go under, and then let's just go a little further here, and I'll give you some nuances because you're not going to be filing a credit, but you at least need to know about this. If you got a PPP loan, it even further kind of makes this muddy. So a PPP loan, when you file for PPP loan forgiveness, you have to report to them wages that you said you paid. And that's the genesis of the forgiveness, right? They gave you a loan to pay people's payroll and other expenses are included, but let's use payroll for this. You had to say, hey, I used that. You gave me a $100,000 loan. I paid $100,000 of wages. Forgive the loan. We're all good. Okay. If you did that, which most people did, you cannot take those same wages for the employee retention credit. You can't use them for both. So you have to really understand PPP law and employee retention credit law because you have to straddle using wages for one or the other to get the most benefit, knowing that you've already used some for the PPP. So, you got to know how to work that system, essentially. I'm making it sound like more sinister than this. You got to know the law.
Yeah.
You have to know, well, I could, because that person is an owner, I could only use a maximum of X for their PPP. Therefore, the remainder can be used for ERC. But if you don't know the PPP law, you don't know how to do that allocation.
Yeah.
You know what I mean? You could be way overstating it. And so that's my point where I led at the beginning to say there's a very professional way to do this that you're totally qualified for the claim, but you got to know how to allocate between the two. And that's where that knowledge of the law comes in.
Yeah. All right. What's the bad? You mentioned earlier there's some bad things that happen. Let's finish it off with just scare us, man. I mean,
I would say this. Obvious. Go ahead.
I was just thinking, the mills, right? All these mills are popping up and it's probably because, like you said, they can now make an offer a lot of people won't refuse,
Yeah.
But also I'm thinking they don't have to deal with the repercussions.
Right.
I know if you guys, am I getting it right that like there's a certain like reputation your firm has with an audit that's gonna like, do they keep track of like, man, okay.
I don't know that overtly, but I would think look, first of all, the background is the IRS that audit many people that don't have the manpower. But if you would use your common sense, if you were an auditor in an area, wouldn't you audit returns by firms that you see doing shady things?
Yeah.
Yes. But yes, I have an ethical standard. Our firm does. We're CPAs. We're licensed. I have an ethical responsibility. Like, I want to do it right. First of all, that's how I want to practice anyway.
Sure.
But a lot of these ERC mills, I can't speak for all of them, but they are coming out and blatantly saying people qualify when their CPA told them they didn't. You want somebody there to defend you in an audit, to represent you. They may not be around. And the point, so you asked me what's the bad news. The bad news is when you file a tax return, you as the taxpayer and sign that, you're liable for it. Now the CPA or tax preparer can get in trouble too. There's paid preparer penalties, but ultimately the responsibility is on you as the taxpayer when you file your tax return. So tread lightly. If it sounds too good to be true, it might be. Ask somebody. Get a second opinion. That's in regards to audits. I was on a continuing education webinar the other day. The guys that were doing it from a big national CPA firm were saying, look, we're starting to see some audits. Here's what they're asking for. They want backup of how you determine that your revenue dropped. Like literally, show me your financial statements. Show me your general ledger detail, which is essentially an export of all your accounting data. Show us how. Show us you didn't take revenue in one quarter on March 30th and move it to April 3rd. Show us. Because again, in the tax world, people got to remember the burden of proof is always on the taxpayer. It's not that the IRS has to say, we need to prove you aren't allowed to claim. No, it's you have to prove you are allowed to claim. Show us how you meet the revenue drop. Show us how you allocated wages for 200 employees between ERC and PPP. Show us. That's the feedback we're getting from practitioners that are going through audits. So I feel confident in the ones we filed because we did the work.
Yeah.
We have the spreadsheets. We can show where we allocated. We did clear calculations of the revenue drop. The clients met it. We didn't move things around. We didn't do anything.
Yeah.
So just be ready to prove. As long as you can prove it, you're fine.
Yeah.
Yeah.
Okay. Yeah. So like that would be like, that sounds like any audit, right?
Right.
To a certain degree. That's why you have accounting, a ledger and a software and all that information, because if you ever did get audited, it's all there.
Yeah, you got to be able to go back and prove what you've done.
Yeah.
Yeah.
All right.
Is that scary or is that
not as scary
what
as
do you
wanted.
think? I know.
Well,
I would love to have a good scary story.
Yeah, I wanted people locked up in jail, homeless.
No, I do think there's going to be some prosecution.
Having to all of a sudden return $2 million, in cash in an envelope in a back alley.
I will say this: one of the things they mentioned on that webinar was that people are getting the IRS is auditing before they pay on big ones.
Oh, okay.
They're saying, "Listen, we're not paying you until you prove it."
Gotcha.
So, yeah, I wish I had some, good, gory accounting stories.
Yeah.
But I think you just beware, man. Just, if it's a third-party company pitching you in a voicemail that they bought your contact information, just
Yeah, and man, think of the, just think of logistically, like if you've already got somebody that, I'm just thinking practically, if you've got payroll, you're probably working with a CPA, and that CPA is going to have all the information that's required for ERC.
Right.
Like, I don't know what advantage you'd have of using an ERC mill
I'll tell you the advantage. It's not an advantage.
Okay.
The advantage is they say you qualify and your CPA says you don't.
Oh, that's I see. The issue. That's the rub.
That's the issue. That's what's happening. And on one hand, I get it. People would say, "Oh, my CPA, maybe he's too conservative.
Mm-hmm.
Maybe he's not." These guys have, you've heard the ads, trained attorneys, IRS loophole. money in your like all the buzzwords.
Sure.
You know, they market it to you. So shame on the accountants. Maybe we haven't marketed as good as our professional ability to do these things. But that's what's happening. So it's not just it's not just either or. Okay. It's they say I qualify, CPA says I don't. Not in every circumstance.
Yeah.
But in a lot of them. I would also say this: if your CPA doesn't do it, get another CPA to do it. I think I just did a claim for a client. Friend of mine's a financial advisor. He said, "Hey, client of mine, their CPA says they're too busy, can't do this." He said, "Would you look at it?" I said, "Sure." And we did it. It was good work for the client, good work for us.
Yeah.
Win-win.
Yeah, but it wasn't a dispute over the.
No, the guy just. I think maybe he doesn't have the expertise, doesn't. Yeah, which I get.
Yeah.
You know, didn't have the time, and we did it.
Yeah. Okay. Well, that makes sense. So yeah, start with your CPA.
Yes.
And go from there, and just trust that they'll point you in the right direction.
Yeah, and I mean, be prepared. Like if you're listening to this now, you kind of have the. I don't expect people to understand the ins and outs of the credits, but you kind of get revenue drop 20 versus 21, max credits. Like have kind of that in your arsenal, at least kind of know what you're talking about.
I think the headline is it's not all false.
Correct.
You very well could qualify
100%,
but and it could all be legit and it could all be done the right way, above board, but
which is the only way to do it.
Yeah.
Like sleep good at night knowing, hey, we filed this right. Got the money. If we got audit, we can back it up. I'm all good.
Yeah.
And we then amended our tax returns, picked it up as income, the whole deal, followed through, everything.
Yeah.
Yeah.
Good little IRS Boy Scouts.
No, I wouldn't say that.
All right. Well, we'll end it there. And look, as always, you know where to go when you need help. Mire.group, and you can find all the other resources there as well. And if you're scratching your head, wondering, hoping you get some ERC credits, then give them a call, reach out, they can help.
Yep. See you next time, guys.
See ya.